Good, good morning for some and good afternoon for others. It's noon here in Nebraska, and this is Lisa Lashendro with Insurance Agency Marketing Services. I am one of the annuity directors here, sales directors here at IMES, and I want to thank you all for joining us. I've got quite the variety of co-hosts with me today that I'm super excited about. We've got John Williams. He is with the Standard, and several folks that I'm going to have John introduce you to at the S&P. So I am super excited that they're going to take their time and take some time out of their day today to go over a deep dive with what these indices are all about. And I do see that we have a few folks here that I don't recognize the name, and some folks that I do see that are already working with us. So for those of you already working with IMES, welcome back. Love to see you participating in our webinars. We spend a lot of time and energy to present these things for our agents contracted with us, not contracted with us, just to make sure you're in the know of what's going out there in our industry. For those of you that are new, I'm going to go over just a few slides here about IMES. Want to make sure you know what you're getting when you decide to partner with us, what you get when you partner with us. We do consider ourselves, I like to call it the IMES family, because you really get that family feel when you work with us. We don't have voicemail. You're going to get that call answered within the first 2 or 3 rings and get a live body. You don't push 2 for Lisa and 3 for accounting. You get somebody on the phone right away. So with that, I'm going to go ahead and get started and give you a little 10,000-foot view on us here at IMES. Obviously, like I was just kind of talking about, we are the IMES family. We really, really do respect that partnership that we have with our producers and agents. So anything we can do to help you improve your business, make more money, I mean, that's really our goal. The way I tell my guys is, hey, I make money when you make money. So the whole goal is to not, see how much you can spend on marketing, but let's work smarter, not harder, and have those numbers go on the positive way. Right out of the gate, we are going to give you a new producer builders bonus when you get contracted with us here at IMES. So whether you write 100,000 or a million or more than a million in your first 6 months that you're contracted with us, we're going to put money back into your business. That could be something different for everybody. So these are just ideas. We love thinking outside the box. You're going to work with myself or your annuity director or your life director, and they're going to help you build your business with what makes sense for you. So don't think this is the say all for what level you hit in the first 6 months working with us here at IMES. These are just ideas. So for some of you, it might be building a website. For some of you, you might just want, the cash or a check to help pay off, maybe some marketing that you've already started, and then we can build on that. So if you have any questions on our new producer builders, please let us know. Next, everybody likes a referral. I don't think there's a better compliment in any sales industry that you're in than a referral. You love them, so do we. But we are going to give you a little something to really let you know that we appreciate that, because without you giving us that referral, we wouldn't see that business. So we give you a little extra override. This is a check that is cut to you on a quarterly basis for whether it's life business, MYGA business, SPL, fixed indexed, depending on the type of business that referral is writing with us, we're going to send you a check, and that's coming out of Steve Murray's pocket. That is not getting split off of any commission or anything that agent or that referral or that you are writing. This is a separate check from IMES to you, thanking you for the referral. And I know I'm going a little faster than I usually do with these slides, but I really we have a lot of content to cover here today. So if you guys have questions, feel free to put them in the chat box and I will follow up with you. in the next day or two, and we'll iron any questions that you have out. And that goes for John's presentation, S&P's presentation, or my presentation here about IMES. The next thing I want to mention is our back office support. Now, our back office support, this is really, really what I think drives a lot of our agents and producers to stick with IMES, because we have a goal. Our goal is to do all the back office stuff because we want you doing what you do best, and that is being in front of clients, that is prospecting, that's just being in front of people and having that connectivity. Let us do all that other stuff for you. You know, let us sit on the phone with the carrier for 30 minutes or whatever it takes to get the status of the pending case for you. Or maybe it's casework, maybe it's illustrations, maybe it's getting the right forms to you. Utilize IMES for all of your back office needs, and let's get you in front of more people. I encourage everyone to save this to their browser as a favorite. Go to www.imesinc.com. Here, you're going to have a plethora of resources at your fingertips, whether that's online, term quoting, whether that's finding the best MYGA rate, whether that's, finding the best or the form, getting access to our e-app solutions. And I'm going to talk to you just a second about that. Sales resource library. I mean, there's one-page concepts. There's all sorts of different things. If you ever want one of your sales directors, myself, I'm happy to give you a tour of our website, show you around on this a little bit, and so that you can take advantage of this as well. On our website, we have Firelight, and usually I have John kind of chime in here, but I know we're short on time today. Firelight is the best way you can possibly submit an application, because you are going to ensure that you have the correct forms. You are going to ensure that you have the accurate information or the appropriate spaces completed. This just saves you so much headache from having to go back and forth to the client, back and forth for the carrier. Your app gets submitted to the carrier much faster and in a more organized way. So that means the standard, that team over there is able to process things faster for you, and you get your commission paid, and the client gets their contract and a much easier and less of a headache, I would say. So if you ever want us to run you through Firelight, show you, the ins and outs of it, happy to do that. If you want us to help you with your first few apps, happy to do that too. Just let us know. Our creative marketing solutions team they're just so brilliant. They can do anything from helping you recreate your logo, maybe even creating a logo, business cards, developing a website from scratch. You name it, we can find a way to make this happen for you. Also, these guys are all in-house. So this is something that IMES pays for to have at your fingertips. If you have any questions on any of our creative team or ways that they can assist you in improving your business, just let us know. Also, when you are writing business with us here at IMES, we will provide you access to Retirement Analyzer. This is a nice platform that you don't have to pay for. We're going to fork the bill here. We're going to take care of that for you. And it's just a nice way for you to go over renewals with your clients, see where things are at. And it's got nice professional charts, pie charts, all sorts of things here that can just help make your renewal and your meetings a lot more professional looking and easy to maintain. IMES Wealth Management. So I'm going to start a poll here for anyone that's interested in learning more about IMES Wealth Management, while I talk to you a little bit about this. So IMES Wealth Management is part of IMES. They are here to help you whether you are registered or licensed or not. The difference is that, you get that same customer service, A to Z, helping you from the beginning to the end of a sale on, clients that you're working with. So that's if you're registered and part of IMES Wealth Management. Now, let's say you don't have a desire to get your securities license, but it might be something that you do down the road. Well, that's fine too. We can help you with those clients. Keep those clients in your own backyard. I mean, I was a registered rep at one point in my career, and it sure did stink before I got registered to have to share my customer, share my business with somebody that had their license, because obviously they're going to try to take everything else. Well, the nice thing about IMES Wealth Management is that we've got an avenue for you to have IMES Wealth Management help you with that piece of business. They won't solicit anything else. And if you do decide to get registered or licensed down the road, we're going to transfer that client right back to you. So I don't know anybody else that's going to do that. Certainly wish I had IMES in my backyard when I was a rep, but hey, I'm here now and I love what I'm doing. But if you have any questions here, definitely select yes, and I will make sure that one of our guys gets with you. So I appreciate everybody for completing that poll quickly. I'm going to go ahead and close it and move on. We have our Life and Annuity Academy. This is another very, very cool perk that you get working with IMES when you're doing business with us. We've got a couple of these that we hold every year. And basically what this is a 2.5-day training, life and annuity training. We take care of all the bills. We take care of your flight, your transportation, your room, your food, your drinks, the whole bit and caboodle is on IMES. And you get a schmooze with other top producers in our industry, hear from the best in our industry. And really the goal is for you to walk away with tools and concepts and ideas for you to grow your business with, your partnership and with us here at IMES. If you're interested in our next one, we just finished our last academy. Man, was it just last week? I think it was just last week. And are interested in going to another one, just throw in a poll here real quick. I'm gonna launch that and let us know, and we'll make sure we get you on the registration. Just want to give it one more minute here. Awesome. And again, I'm sorry I'm moving so fast here, but if you guys ever have questions, let us know. We are a marketing organization that likes to reward our producers for their production. So this year, we are taking those that hit 4 million points. It was at 4.5, but Steve lowered it to 4. We're going to the Greenbrier here. The qualification period does end here in June. So it ends at the end of this month, but stay tuned. We will be starting a new qualification right away after that. And the next trip shall be announced. So just keep your eyes open. We'll be sure to announce that as soon as we have everything booked and ready to go. We are a marketing organization, guys. So of course we have Facebook and LinkedIn. Feel free to jot these down. And while you do that, I am gonna switch my screen over to Mr. John Williams. And I'm gonna let you take it away. Again, we are short on time to cover everything we want to cover here today, folks. So if you have questions, please jot them down in the question box. And John and myself or any of the other speakers here today will be happy to get back with you with any questions, or even have a short 5 or 10 minute call with you, conference call. We're happy to do that as well. So just be sure you jot those questions in the question box here, and we'll address them, within the next day or two. John?
Okay, thank you, Lisa. I appreciate your time, and everybody out there. Lisa, maybe you could switch the power, or if you will, over to Peter to show his screen for the presentation. Sure. My name is John Williams. I'm a regional sales director with the Standard. We work with folks like IMES and Lisa, and are here for you to help you and help you grow your business. We just rolled out a brand new indexed annuity called Enhanced Choice Index. and we partner with the good folks from S&P Global. We have 4 index options that you can choose from, your client can choose from, which S&P, the folks from S&P will go over here shortly. The Enhanced Choice Index is built for accumulation. It is uncapped. We have participation rates, guaranteed participation rates for 5 or 7 years, and we also have enhanced participation rates for a fee. All of the indexes, which I like to consider the engine of our fixed indexed annuity, are from S&P. We thought that was clean and concise. It's easier for your client to understand. You're not having to explain different management companies and brands. Everything is clean and concise with S&P Global. So we're proud to partner with them. If the indexes are the engine of our fixed indexed annuity, the steering wheel is our participation rates. Remember, we have uncapped participation rates, and they're also guaranteed for the term if you choose any of the low volatility indices, which we'll talk about today. It's really a unique feature in the industry. You won't have to worry about explaining a renewal cap rate or excuse me, a renewal participation rate because they will be locked in and guaranteed. And if you're looking for even more accumulation, you can purchase up what we call an enhanced participation rate, which is also guaranteed for 5 or 7 years. So very unique. We're proud to offer it. We're an A-rated company for AM Best. We're one of only 8 life and health carriers that have maintained an A or better from AM Best for 93 years, for the entire time that they've been rating insurance companies. So that's a quick commercial in regard to the actual product itself. I'm happy to go over it more in depth after this webinar is concluded, along with Lisa, or Lisa can reach out to you, but we're proud to offer this product, and we're proud to offer it through IMES. So with that, I will introduce our panel from S&P Global. We have Brandon Haas, Melody Dwan, and Peter Sim, who are online with us now, and they can give an overview and do a little bit more of a deep dive of the 4 indices that we offer, the 4 engines, if you will, of our fixed indexed annuity. So with that, I will turn it over to you guys. Thank you.
Hey, great. Thanks, John. This is Peter Sim here, and I manage the standard relationship on behalf of S&P Dow Jones Indices. So very, excited to be on this call and speaking with all of you. We're on this call to essentially, do a deep dive into the 4 different index strategies that the Enhanced Choice product is built off of. It's been a long time in the making, and we've done a lot of testing and so forth, but we think we've built a product in partnership with the Standard that's choosing some very successful index strategies. Obviously, our brand name and some of the indices that everybody is familiar with, but we've chosen 4 strategies to really take this product, help it grow in a rapidly growing index annuity space. But they're very successful strategies. They work, they do their job, and they're built on transparency and simplicity, with kind of the insurance market in mind and the end user in mind. They provide very specific benefits around the upside potential, but more importantly, I think at this time with rising, they provide very powerful downside risk protection. So my colleagues from our product management team will do a deeper dive, but yeah, just very quickly, just wanted to highlight we're going to dive into the benefits of a risk control industry index framework, a multi-asset framework, and then really talk about the evolution of the ESG story, and specifically within the insurance industry. And at the end of the presentation, there are a number of resources in terms of marketing collateral and information on our public websites that you can utilize. And I think John will be sending that around to everybody. So from here, I'll pass it to my colleague Melody Dwan to talk about the 500 and some of our multi-asset and strategy.
Thank you, Peter. And as Peter said, we're really excited here to give you the overview on these indices and really help you understand how they work and be able to explain them yourself, right? So starting with the first index in the lineup, it's the S&P 500. So it's very familiar, one of the most recognized index in the world. And kind of just to give a quick overview of the relationship between these four indices in this product. So we have the 500, and the other three risk controlled indices are still giving you the exposure to the 500, but with a little bit of a twist that we're going to dive into more. So if Peter, you'll go to the next slide, we can start with the 500. You're probably all super familiar with this, so I'll give a very brief overview. It's one of the most recognized index in the world and the oldest, created in 1957. At the moment, there's about 13 trillion or so benchmarked to the 500, so it is widely used and tracked. And just going into the next slide, let's give you a quick overview of how this index is constructed. It's the 500 leading companies, publicly traded companies, right? And just weighted by their float adjusted market cap. So something we like to highlight about, why the 500, why not some of the other equity benchmarks out there. So the 500, it's not as concentrated, right, as some of the smaller equity benchmarks that may have just 50 or 100 companies in there. So you're not placing active bets on any of the sectors. You're getting, it's a very balanced sector exposure that you're getting. And so it's an index that's very representative of the equity market and what it's doing. And it captures approximately 80% of the equity market cap, right? So almost all of the US economy. And so the next thing we also like to show is a very famously debated, the active versus passive debate. And that's one key number we'll just highlight is, 80% of active managers cannot beat the 500. And so it really is a very representative benchmark in that regards. And so moving on to the next index. So as we said, the next three indices, they're all risk control indices. So they are starting with this MARC 5. Some of you may have heard of it. It's relatively popular with carriers at the moment. So this is the multi-asset risk control index. And it still gives you the same exposure on the equity side to the S&P 500, but just bringing in additional asset classes for diversification, right? So we have on the commodity side, we have gold, which is a proven long-term hedge against inflation, right? It tends to hold its value even when currencies are decreasing in value. So recently, I'll give an example. Recently, year to date, equity is down something like 20%, but gold is positive. And on the fixed income side, we have the 10-year US Treasuries. And so, kind of as I alluded to earlier, with the inflationary environment recently, with the rising interest rates that we're seeing, we've seen a lot of shift to multi-asset, and this focus on diversification to really help your clients weather the impact that this has on asset prices, right? So, and when we designed the MARC 5, we've really designed it based on that solid financial theory, and we've designed it to be as simple as possible. So it's just these three asset classes. It's the 500, it's gold, US Treasury, and with the risk control overlay. It's very simple, and that's why it's been so popular with carriers. It's easy to explain and understand how the index works. So this index was launched in 2017. So we have, 6 years or so of live track record at this point. It's seen great adoption since launch. And at the moment, we have about 8 billion assets tied to this index. And so just to dive a little bit deeper into how this index works, as I mentioned earlier, we've got 3 asset classes, right? So step number 1, we've got to come up with how do you allocate amongst the 3 different asset classes. And that's very simple. So it's all based on volatility. So let's say right now, equity markets is very volatile, the S&P 500 is very volatile. Well, the index is going to allocate less to that and more to treasury, more to gold, and vice versa. So first we determine how to allocate amongst the asset classes, and step number 2, we have a leverage component to lever up or down the exposure to the overall index, right? So when overall markets are volatile, we will lever the overall exposure down to bring down that exposure. So that's all the index is doing. And so, a lot of other multi-asset solutions out there can get pretty complicated. And with this one, it's really a 2-step process. It's based on volatility. Volatility is the signal. There's nothing else that we're using there. And so that's something that we really like to highlight. And so kind of moving on to address, what does that mean for this index performance wise? I have some numbers up here that I can quickly run over. So year to date, we know equity markets have been very volatile. The S&P 500 is down 21%. And by comparison, gold is positive, and that's really helps this index, right? MARC 5 is only down 8% compared to the S&P 500. So that's the downside protection that you're getting, and that diversification benefit. So what that all really ties out to is the index is striving to create more stable returns through all sorts of market environments, right? So that's the key thing. And so moving on to the next index, this is the S&P 500 risk control 5%. And so, similar to the MARC 5 we just talked about, it's that same risk control overlay. And so this index has been around for a little bit longer, actually. So the risk control index was launched in 2009. So that's more than, 13 years of live history. So this risk control mechanism, it's really been tested through a variety of market conditions, right? And so that's all live track record. And with the 500 risk control index, it's even simpler than the MARC 5. It doesn't have the other asset classes. It's just S&P 500, and we're adjusting the allocation to the S&P 500 when it's volatile, more to the 500 when it's less volatile. We're trying to capture some of that upside participation, right? And so it's got this date that allocation is changed on a daily basis, right? So we're responding very quickly to any changes in the market, and it allows you to give that customized target of volatility target that's desirable for your client. And so I kind of want to talk a little bit also about, so you've seen a lot of this about risk control, volatility control, and like I highlighted earlier, what this really is trying to do is just limit those extreme highs and lows to create more stable returns for you through all sorts of market environments, right? We want, and what that also means in the end is a higher chance for positive returns. So kind of moving on to the next slide. So here's a little bit of a graphic. Excuse me. Here's a little bit of a graphic to better illustrate what I was talking about earlier. When the volatility goes up, index allocates more to the S&P less to the S&P 500. Volatility goes down, allocates more to the S&P 500. Very simple, very straightforward. And so kind of moving on to the next slide, what that all means for you on a performance level. It's really meant to protect you on the downside and protect your client through all sorts of volatile markets, right? So one example we'll highlight here, during the 2008 financial crisis, you know, the S&P 500, that was down like over 50%. Meanwhile, the S&P 500 daily risk control, this index here, the risk controlled index, was only down 8%. So that's a lot of downside. That's very significant, right? That's a huge downside protection that you're getting. And you're also going to be a lot more quicker to recover from these extreme events as well. So moving on to the next one, this is the S&P 500 ESG Daily Risk Control Index. So the ESG index is a little bit of a newer index. So the risk control here was launched in 2021, so just last year. But as I highlighted earlier, right, it's this exact same risk control mechanism that has been tested has the live track record for many years. So this, it's all the same mechanism that's being used here, and very easy to understand. So I'll hand over to my colleague Brandon here to talk a little bit more about how we go from the S&P 500 to the S&P 500 ESG index, and explain how the whole ESG scoring works. Brandon?
All right, thanks so much, Melody, and all the fellow speakers and participants here on the line. Yeah, so as Melody mentioned, I'll cover our ESG ratings criteria and our methodology, some of the history, and kind of what that's led to within our respective indexing space. So if you want to actually move to the next slide, for those that are not familiar with ESG, and even those that are, I think that there's a few different ways that we can maybe articulate, what ESG means to us. But at S&P, we really think of ESG as the environmental, social, and corporate governance issues that are shaping investor activity and company strategy. And why I mention that specifically is because we look at it from, I think, kind of two vantage points. The investor activity, again, and the company strategy. So it's both the owner and the operator, and where there's certain risks and opportunities within those inputs that are financially material. And that's essentially how we build our indexes. And so going back, S&P Dow Jones indices was actually the first to launch our Dow Jones Sustainability Index back in 1999. So our methodology that we've applied today has certainly evolved since then, but sustainability has really been the bedrock of our data inputs for a couple decades now. And what I wanted to highlight here is how we collect our data and what makes that unique to us, and hopefully, kind of what we would consider the most robust input process for ESG ratings criteria out there currently. So in front of you, what you have, if you're looking at the visuals here, is a slide on our what's called corporate sustainability assessment. And so when we think again about ESG, a lot of this is some non-financial information that we have to turn into financially material reporting constructs. And so the way that we've done that is by creating essentially a survey system that asks a multitude of questions that are really industry specific. And so there's sometimes different positions on ESG depending on maybe what industry you're looking at. Can you compare an energy company to a finance company, or a materials company to a manufacturing company or restaurant? And the answer is, in some aspects you may be able to, but realistically it should be nuanced and specific to that materiality of that industry. So within the CSA, we cover 11,500 companies with this assessment, which is 99% of global market cap. And we essentially invite companies to actively answer questions and participate proactively with Standard & Poor's. And those questions, again, are broken into 61 industries that we repackage back into essentially kind of 23 criteria scores that leads back into the 11 GICS sectors. And I'm mentioning that because later I'll kind of cover how we reconstruct the index, provide similar risk return profile to the parent index. And what we found through this experience over the last 2 decades is an increase in participation rates. And that's really important because now at S&P, we've been able to create kind of this feedback loop that allows us to understand what the publicly traded companies are working on within the ESG spectrum, and how we can evolve and continue to ask poignant questions that, again, are industry specific, that allows these companies to then, in preceding years, evolve their approach. So it's a very active strategy that we have, and it's specific to S&P that a lot of other index providers don't necessarily have access to. And so most recently, we've seen that around 65% of the companies that are participating actively are actually providing some non-publicly disclosed information to us that allows us to, again, kind of fine-tune our lens as we're putting our indexes together to see, hey, is this information financially material, and how can we replicate a parent index to provide an improved ESG score while mimicking historically similar risk return profiles. So very, very robust process, all done internally, that allows us to essentially have approximately 700 billion data points that we reapply to certain indices. So on the next slide, this is an illustration for the S&P 500 specifically. So, I wanted to articulate this slide because the process typically begins with exclusions. And a lot of folks think about the world, again, exclusion only. And so we just start with exclusion. So certain businesses are excluded depending on their revenue or ownership of certain revenue. And that would include things like tobacco, controversial weapons, thermal coal, companies that are non-compliant with the UNGC or the UN Global Compact on human rights issues and violations. We also now exclude things like oil sands, small arms manufacturers, and military contractors. And then essentially what we'll do, as I mentioned before, is look at our ESG scores from that corporate sustainability assessment, and we'll remove the bottom 25% within each GICS industry. What that then allows us to do is look at the remaining universe. And the remaining universe is typically then around 400 or just under 400 names of the 500 that we start with in the S&P 500 index. And we then weight those companies based on that ESG score to target 75% of the underlying index within each GICS group. And then how do you put Humpty Dumpty back together again? Well, you take those remaining names and you apply them back into the index with their float adjusted market cap for their particular GICS industry and group. And so what you end up with is looking at 500 names, and then typically we'll kind of put it back together with around 300 and change names that historically, again, has provided a very similar risk return profile to the parent index while improving the ESG outcomes, and kind of happy circumstance over a multitude of actual years and back-tested years has nominally improved the performance experience above and beyond the parent index, again, at least historically. This index launched for capital market investment in 2019. So the S&P 500 ESG has been around for about 3.5 years. But again, the methodology has been in place for over 20. So a lot of deep-seated history and just new application for our index overlays. And then when we look at the risk control, kind of as Melody mentioned, our processes have not changed, but our implementation of kind of the layers, continues to evolve. So what we'll do is we'll replicate the ESG 500, we'll put it back together, and then essentially overlay the risk control measurement on top of that 500. So you're getting sustainability with that risk control measurement that Melody alluded to in this context. The next slide. So, if you were to look at kind of the trend line here, since 2008 and compare that to another slide that Melody had captured previously, again, you'll see very, very similar experience. This obviously encapsulates our ESG risk control, and so the outcomes are very, very similar to the risk control SANS ESG. Next slide. So here, what I'll probably do is turn it back over to Peter. But again, what I'll probably say is that, as you're considering these indexes, whether you have a client that's interested, in impact or not, take a look at what the ESG 500 experience has been thus far. And we think that, especially for some of these longer term products that your clients might be using them for longer term purposes, that ESG adds this layer of risk mitigation and opportunity enhancement. So with that, I'll turn it over to Peter to cover some of the supporting resources.
Thanks, Brandon. Appreciate that. And yeah, just to wrap up, just wanted to highlight, a fraction of the publicly available resources that we have for all of you. I think John will be sending this to the audience later today, but all of our indices have a public website with 10 years of history, a fact sheet, and methodology. So I know we've done a pretty deep dive into, the nuts and bolts of each of these indices, but what we really want to bring it back to is the simplicity and, more importantly, the transparency. These are all rules-based indices. We're not making any decisions, but this is all following a very specific methodology that we publish, on our website. And in terms of helping end users, distributors, everybody understand each of the indices, we've have a ton of marketing collateral and resources that you can utilize. All of our indices have a one-page brochure. So this is second bullet point of under each index. This is a great thing just to print out, show your client, and it gives a very 10,000 foot view of what the index does. If they want to go a little bit deeper, we have a big team of researchers that really look at how the index is behaving in certain environments. We have a lot of specific resources dedicated to the insurance market. And finally, I'd like to highlight, specifically for the MARC 5 on the bottom left, we have things like motion graphic videos. So this is a nice, 2-minute video that, just kind of explains everything for you on a very simple basis, a lot of simple illustrations and so forth. But beyond that, we ourselves are, your resources as well. So, John can pass around our contact information. And if you do have, more specific questions about methodology, or you just need, some additional data points on any index, we'll be happy to provide that as well. And with that, I think that's it for S&P side. So I'll turn it back to John.
Thank you, Peter. I appreciate your time and everyone's time. Hopefully you got a better overview and comfort level with some of these indices that are available with the Enhanced Choice Index. And I will, Lisa, do I want to hand it over to you to land the plane?
Well, I don't know. Do you want? Thank you guys. You really did a beautiful 10,000 foot view of the S&P and these different indexes to choose from. Bravo to all of you that joined us today and went over these. So I thank you guys at the S&P for doing this. John, we have a few minutes? Let's do a real quick overview of the product that these are found in over at the Standard. Do you have something there? You want me to switch the screen over to you?
I could just go over some quick points in regard to the Enhanced Choice Index. I don't have a prepared presentation to share with you. As I mentioned before, it's a brand new product. It is built for accumulation. It's an uncapped product. We only offer participation rates. No cap rates are offered. and we have a unique feature in that the participation rates can be locked in. They can be guaranteed for either a 5 or 7 year term. We also have the ability, since it's built for accumulation, the client can, for a fee of 1.5% per year, purchase up what we call an enhanced participation rate, which is going to give you an even larger opportunity for upside index to these 4 indices from S&P 500. And for example, an enhanced participation rate on our low volatility indices from S&P is currently at 170%. So that can be locked in for 5 or 7 years. So if you're dealing with the engine, if you will, the engines that are offered by S&P that we just went over, then you apply the steering wheel, which is our participation rates that can be as high as 170%. So we're proud to be able to offer this. It's a unique, pretty simple design. We've always designed our indexed annuities for accumulation and for simplicity. And I'm happy to go over the product with anyone individually, along with Lisa, to position it how it should be positioned with clients and any other issues or questions that anyone may have. So we're proud to offer it. As I mentioned, it is brand new. So just remember, it's built for accumulation, guaranteed participation rates, enhanced participation rates for a fee. All the S&P indices and they have many of them have a long track record and return history. And the Standard has been around for over 100 years, and we're one of only 8 in life or health carriers to maintain an A rating or better for the past 93 years. So with that, if Lisa, if you want to open it up for any specific questions or take it away.
Yeah, absolutely. So a couple things I want to just reiterate here, and I don't know if you guys have caught on to the simplicity of how these options work with the S&P. So I know when I'm talking to agents out there, they're saying, well, they're not 100% sure. They just want to stick with the solid S&P, and they're not sure about the MARC 5, and they're not sure about the ESG. And so there's just some concerns out there with that. Well, we don't need to overcomplicate it. And the one thing that I love about this product and the variety that the S&P is offering with this product at the Standard is the simplicity factor here. And you don't need to overcomplicate it with your clients either. They have some nice short term of 5 years for FIA. They have the true up factor. So if you do want the enhanced participation rates and everything kind of tanks, your client can be rest assured that they're going to get that fee back for that participation enhancement. We've got all the tools, these fine folks at the S&P that are willing to step in and, talk, to you or help you with presenting, how to explain these indices. I mean, we've got all the tools you could possibly need. So take advantage of that. A lot of folks don't realize that you have people like John, myself, and all the tools here at IMES to help you with these presentations and help your sales process go real nice and smooth to offer your clients the best results that they could possibly expect. With that, I mean, you guys, this was an amazing webinar. We did record this. I will be sending this out to everybody as well as some of the handouts. I'll send you the spec sheet for the products over at the Standard that we're addressing here today, as well as some of those nice handouts that our pals over at the S&P were so kind to put together for us as well. I don't see any questions here to address at this time. I think that just tells me that you guys did an amazing job in your presentation. We will be doing another webinar with the S&P and John Williams as well. So with that, I'm going to end my poll here and just thank everybody for your time. Appreciate seeing all of you here today and talking to you guys at the S&P once again. And John Williams, it's always a pleasure. And everybody enjoy the rest of the day and be safe. Thank you, everybody.
Thank you, Lisa. Thank you, Peter, and your team there. Thank you, everyone out there.
Have a good day. Thanks, everyone.
Thank you. Bye.
Bye-bye.